This seminar is designed to familiarize small business owners with basic accounting principles needed to make your business successful. First, what is accounting? Let's highlight 2 points here: systemized and management reporting. Accounting is a system, and like any effective business system, requires management's involvement. Management identifies the information that is vital to them to track business trends and to make critical, timely, and effective decisions. In order to make business decisions, an owner must understand basic accounting terminology and be able to understand the information contained in financial reports. Now that you've studied some basic accounting terminology, it's time to apply that knowledge to talk about some of the basic financial accounting reports that you will use to guide you in making decisions. These accounting reports are the results of the recording of financial activities for your business. When recording assets, liabilities, and such items in the ledgers, the information is used to produce the following reports. Careful attention to the recording of this information using generally accepted accounting principles is vital to the output of these reports. Let's take a moment to look at this sample balance sheet. First, notice that this is the balance sheet for December 31st, 2007. It represents the financial conditions at a moment in time. Second, notice that total assets equals total liabilities and equity. This is why this is called a balance sheet. Total assets must always equal total liabilities plus equity. Take a moment to look at some of the other line items represented here. We'll go into more detail later about those. However, for now, let's talk about where the balance sheet fits into the hierarchy of reports. As seen in this visual representation, the balance sheet is at the top of the financial hierarchy of reports. Before a balance sheet can be created, information from the supporting reports, as we see beneath, will need to be tabulated and reported. In the slides to come, we will discuss each of these levels. For now, let's talk more about the balance sheet. The balance sheet is most useful when compared to others from past reporting periods. This will establish a trend that can be analyzed to make business decisions. This is an example of a comparative balance sheet. It takes balance sheets from similar time periods and compares them. The change column shows the differences from the first period to the second. According to this balance sheet, the company is profitable. On line 2, we can see that the company is moving to an illiquid position. Line 3 reveals an increase in accounts receivable. On line 9, we can see an increase in fixed asset purchases. Line 25 shows an increase in debt repayment. Line 31, an increase in retained earnings. And on line 32, we see an increase in owner distributions. Notice that the amount on line 18 equals the amount on line 34. You might be asking, if we're profitable, where is the money? Note: over the course of 1 year, the profile or image of the company's balance sheet was changed, but total assets continued to equal total liabilities. The change in balance sheet was reflected evenly between total assets and total liabilities and equity. The owners should also consider their personal cash needs and budgets. Assets, A, equals liabilities, L, plus owner's equity, OE, which defines the balance sheet and which is required in reporting. Think of a scale that is always in balance. This representation graphically depicts the balance between assets on one side and liabilities and equity on the other. These numbers represent, in simplistic terms, dollar values. The terms debit and credit can be used to describe the left and right side of the general ledger T accounts. Debit refers to the left side, while credit refers to the right. Notice that in our depiction, debits equal credits. For every debit, there is a credit, and vice versa. A warning: it is common for debits and credits to be mistakenly thought of as positive or negative values. Debits or credits are neither positive or negative values. The balance on an account is either a debit or a credit, not a positive or a negative value. This depiction shows examples of debits and credits. Each account is its own T account. The debit accounts of cash and accounts receivable have T accounts on the left side or debit side. The credit accounts of accounts payable and equity are on the right or credit side. Typically, assets have debit balances, liabilities have credit balances, and equity accounts have credit balances. Each account has its own balance. You'll notice that we have placed a value on the appropriate side of each of the mini T accounts. These values represent the balance for the corresponding account. Notice as we combine the debit balances and the credit balances. Liabilities and equity remain separated. Assets, A, equals liabilities, L, plus owner's equity. If there were more than one credit liability account, they would be combined, as would multiple equity credit accounts. We will show such examples in future slides. Each time you record a transaction, such as issuing of an invoice or collection of a payment, in a computerized accounting system, a journal entry is automatically created behind the scenes. Some journal entries, such as depreciation expense, are initiated or created manually by the user. Here we will demonstrate the recording of the owner's issuance of stock. Remember that on the balance sheet, debits must equal credits, or, put another way, assets equals liabilities plus equity. Let's build upon our previous example to show the effect of the owner's issuance of stock on the T accounts. An entry of 5 is placed in the cash debit column, and a balancing credit made to common stock. Common stock is equity. Notice the effect on the T accounts. Let's take a moment to look at this sample balance sheet. Accounts receivable is unchanged. Debit balances now equal 9. Second, notice that total assets equals total liabilities. Take a moment to look at some of the other line items represented here. We'll go into more detail. In this example, the business records a collection for accounts receivable. Both accounts are assets. Cash has been debited by 1, and accounts receivable credited by 1. Again, building on our previous example, let's look at the effect on the T accounts. An entry of 1 is placed in the cash debit column, and a corresponding entry of 1 credited to the accounts receivable account. The cash balance increases by 1 to make the balance 8. Accounts receivable balance decreases by 1. Debit balances remain equal to 9. The credit balance also remains unchanged at 9. We hope you have enjoyed Accounting Basics for Business.